In this video, we're going to be picking up where we left off on the statement of cash flows. Last time we calculated a simple example. Now we're going to learn some more advanced concepts and do a complex example. This is the thing that you will need to know for the test. For the test, I will ask you to complete a complex example of a statement of cash flows. So if you will look in your syllabus for the complex example, you will see that we are still working with Pretty Puppies, which has essentially all of the same accounts. However, we've had a few things that have changed. For example, when we look down near the bottom, we now see additional information in the notes section. Instead of just learning what we paid in cash dividends, we also learned that the company sold some equipment and they sold some long-term investments. Occasionally what will happen is the accounting department will send you notes and they will tell you about purchases and sales that they have made during the year. Or sometimes they will just tell you about sales, and from the T accounts and what's going on, you will have to figure out if there were any purchases that they didn't tell you about. So when we look at our notes here, we see that the company sold equipment for $200. The equipment cost the company $210 and there was depreciation of $20 on the equipment. Well, now we need to take this all into consideration now that we know more. Let's go back and look at the example that we were working on, the exact same spreadsheet with the exact same notes. I'm going to make a few alterations to the appearance here. I'm going to hide some columns and I put in a split screen so that now we can scroll down and we'll have a little bit of extra room to work. Alright, so we need to make some notes about what we've learned in the syllabus. So the first thing we see is that the company sold the equipment for $200. If they sold the equipment for $200, we know that that represents a cash inflow. We come back to our statement of cash flows, and in the investing section, we're going to wipe out what we had dealing with investing. We wiped that out because we previously were only able to glean information from the beginning and the ending balances, and we surmised that we had an adjustment based on the difference in the balances. However, now we have more information and we can fill in a couple of gaps. So I'm going to add a few lines in here. And we know that we sold equipment. And the selling price was $200, so that goes in here as a cash inflow directly under the investing section. Then when we come back, we read that the equipment cost the company $210. Now we need to make a T account to see if everything is even in the T account after we report the sale that we know about. So we're going to make a T account for property, plant, and equipment. Okay, and then we're going to plug in the numbers we know. We know that we had a beginning balance of $542, and we know that we had an ending balance of $975. Those come directly off of the comparative balance sheet. Then we also know that we sold some equipment. You may remember from your financial accounting class that when you sell an asset, it comes off of the books at exactly what you put it on at. So whatever its purchase price was is what is going to come out of this account. A way I like to think of this is, instead of an account with numbers, I think of this T account as being a storage room where you put all of your property, plant, and equipment into. So you put it in and it had a price tag on it that said $210. When you pull that equipment back out, you're pulling that piece of equipment out of the storage room with that same price tag still attached to it. So we're going to take that out at $210, and if you remember, the correct way to take that out is to credit it. That means you're going to subtract. Those are the only events that we know about, the beginning and ending balances and the sale of equipment. So when we do the calculations, we should have 542 minus 210. And if nothing else happened, let's cover this number up here for a second. If nothing else happened, we should have an ending balance of $332. Then we have to look at the ending balance to see if we did have an ending balance of $332. No. We had an ending balance of $975. What that means is something must have happened to bring our balance up from 332 to 975. Well, the only thing that could happen to bring that balance up would be a purchase of property, plant, and equipment. The accounting department is not always going to tell you about purchases. They let you figure it out from the numbers. So you have what I like to call a hidden purchase. And it's going to be the difference between what the ending balance was and what it should have been if nothing else happened, $643. Now we go back up here into the investing section and we're going to record that hidden purchase that we just calculated. Now we don't know whether it was property, plant, or equipment because the title has all three, so we're just going to put purchased property, plant, and equipment. And we're going to bring that number over and we're going to make it negative because that represents a cash outflow. Remember, when we see that we have an increase in an asset, we assume that we went out and paid cash to make that asset increase, right? So we assume that we bought the property, plant, and equipment on cash, which then represents a negative cash outflow of $643. Then we go back and take a look at the problem. We're not quite done with this yet because it says there was depreciation of $20 on the equipment. That's not uncommon to take depreciable assets off of the books. But when you do, if you take off something that has depreciation associated with it, you have to take depreciation out of the accumulated depreciation account. Because when you pull an item out, you pull out everything that is associated with it. So we're going to make a T account for accumulated depreciation. And we're going to do the exact same thing that we did before. We're going to put in our beginning balance, which we knew was 96, but it's a credit balance. And we're going to put in our ending balance of 124. See how these numbers are showing up as positives? That's because they were positive credits. The natural balance should be a credit. And remember, I said when we sell something, we take off not only the piece of equipment that we sold, but anything associated with it, which would be the accumulated depreciation. Our problem says that that was $20 right there. So I'm going to put 20 in here in my debit column. And I'm going to black this out for just a second. And we'll take 96 minus 20. If nothing else happened, we should have an ending balance of 76. Then we go back and we look at what the ending balance was. It was not 76, it was 124, which means that something had to have happened to bring that up from 76 to 124. And what happened is that we had $48 of accumulated depreciation that was added in during the period. And if you remember from the previous video, we did the journal entry for accumulated depreciation, and we said that one side of that journal entry is depreciation expense, that's the debit side, the other side is accumulated depreciation. So to make the accumulated depreciation credit by 48, it means we had an offsetting debit of depreciation expense. This 48 represents that debit of depreciation expense. So then we come up to the operating section and we look at depreciation expense. We're going to change this number from the 28 that we calculated earlier to the new 48 that we have calculated. So what you're going to do is you are going to forget how we calculated it using the simple method. You're going to replace it by using the T account. That number should now come exclusively from the calculation in the T account, not just from the differences in your beginning and ending balance. So now we need to see if there were any other items, and I believe that there were. We had the company sold long-term investments for $100. So we need to go back and put this into our investing section. We're going to do exactly what we did with the equipment. We wiped out what we had previously. That method is gone. Now we don't just calculate the difference between the beginning and ending because now we have more information. If the accountants don't give us any new information to go on, we can just take the ending minus the beginning and make assumptions. But once we have new information, we have to record the information that we have. So we know that we sold long-term investments, and the note says that we sold them for $100. We assume that we got cash for those. Those are going to represent a cash inflow, 100 bucks. Then we have to go back and figure out what we paid for them because we have to adjust the T account and see if we have any hidden purchases in long-term investments. It says that the company originally purchased the long-term investments for $130. So let's make a T account for long-term investments. Just like before, we're going to enter the beginning number. We're going to have to come up here a little bit to get it. The beginning number was 433, comes directly from the balance sheet. The ending number was 322, comes directly from the balance sheet. And we're going to take off the sale. We sold long-term investments, and the problem told us that we paid $130 for those. So we take those off. Remember, we treat it like it's setting in the vault with a price tag on it. When we bought it for $130. When we take it out, it still has that same price tag of $130 on it. We're going to subtract 433 minus 130. That gives us 303. If nothing else happened, our ending balance should be 303. But it's not. It's 322, which means that we had another hidden purchase, or i.e. just a purchase that accounting didn't mention to us because it wants us to find it ourselves. And all we have to do is take 322 minus 303. We had a hidden purchase of 19. That hidden purchase of 19 comes back up here, and we record that we purchased long-term investments, and that's going to represent an outflow of cash because we gave money in exchange for it, negative 19. We're going to sum up this column now, 362. So that column is actually going to be a little bit different than it was in the simple example based on the new information we have. We're not quite done yet, however, because we have one more step with the items that we sell. We have to calculate any gain or loss on those items and enter the effect on our statement of cash flow. The formula for calculating gain and loss is this. We take sales price less original cost plus any accumulated depreciation that was on the item and that should equal our gain if it's positive or a loss if it's negative. Alright, so on my equipment, my selling price was the 200. My cost was the 210. And remember, that's going to be a negative, or that's a less, right? And then we're going to add back in any depreciation that we had associated with that. We said that was 20. So then we sum up those three things. And we had a gain of 10. We're going to make room for that up here. Gains and losses always get reported in the operating section. So we come up to the operating section, and now we're going to make some room. So now I've made two blank spaces because I know that we're probably going to have a gain or loss on long-term investments that we sold as well. In the first blank space, I'm going to enter my information here. Okay. I'm going to enter gain. Oops. gain on sale of equipment, and it was 10, but it's going to show up as a negative 10. You have to flip the signs on both your gains and your losses. And the reason is that gains and losses, just like depreciation expense, are accrual basis concepts. They don't represent what happened with the cash directly, right? So we had a gain of 10, but that gain was already incorporated into the sales price and all of those other accounts. And because it's just an accrual basis concept, we would have had income that would have been increased by that gain. It needs to actually go back down because we didn't get an extra $10 over the other things that we're reporting, so we have to take it back out, so it shows up as a negative. If we had a loss, it would be just the reverse. It would have caused income to be too low, and we would have needed it back to add it back in to represent that we didn't lose an additional $10. So on this gain on the sale of equipment, Q-U-I-P-M-E-N-T, right? It's going to show up as a negative 10. Then we go through and we're going to do the same calculation on the long-term investments. We have the sales price, which was $100. We had our original cost, we'll subtract that out, at $130. There was no accumulated depreciation on this because long-term investments are not depreciable assets. And so we're going to sum those just like we did before. And we have a loss on this sale of 30. And we can tell it's a loss because it's a negative number. So we're going to go up here and report that in the operating section. Loss on sale of long-term investments. Notice how I'm typing all of these out longhand in the actual statement of cash flows. That's because I'm going to expect you to write everything out longhand when you do it on the test. Alright, so the loss on the sale of long-term investments, remember we have to flip the sign. So it's going to equal a positive 30. Because again, that's just an accrual basis concept. The actual loss all comes out in the wash when we report all of the other items that go into it. And this brings us out to a positive 466 now for the operating section, negative 362 for investing, negative 149 for financing. Notice the financing didn't change with any of those adjustments. Our beginning cash was still 60. After all of the changes, they still netted out to a negative 45, and the ending cash is still 15. If you look up here at back up on that cash reconciliation. So let's double check and make sure everything's looking right here. So we have 496, which now incorporates all of the items we've added. The investing is now at 362. Let's double check that just to be safe. The financing section didn't change at all. It's still at 149. Our beginning cash of 60 still comes from up here, our beginning balance in our cash and cash equivalents. The net cash outflows is the summation of the subtotals from each of the three sections, negative 15. And when you have negative 15 added to positive 60, you come out with ending cash of 45. And if we check the cash and cash equivalents, the ending balance should be 45. So we've made all of our changes correctly. This concludes the changes for the complex statement of cash flows. If you have any questions, please post on the discussion board or send me an email. Thank you.